And today I have Heath Ritenour, who is the CEO of our company of the Insurance Office of America out of Longwood, Florida. And Heath and I are going to talk briefly today about what's going on in the insurance industry with specific regard to the pricing and why you may be seeing price increases where you're going, listen, my numbers are down and so forth, but why are my rates going up? So without further ado, Heath, thanks for joining me today.
Oh, it's a pleasure. I appreciate you having me, Brian. I can tell you one of the things in our industry that's kind of confusing to most people. I know as a buyer of insurance, not just a guy in the insurance business, it's frustrating to myself, and I'm sure it is to any business owner, that if your plan, so to speak, or your policies have performed, meaning you haven't had many claims, why in the world would you pay more in the future than you paid in the past if the insurance company didn't pay out claims? And so what I'd really like to do is just take a few moments to kind of explain the way insurance works, because many agents don't really dive deep enough to explain it. They'll just tell a customer, well, there's capacity issues, there's been wildfires and hurricanes and natural disasters. So because of that, the market's up. But the reality is there's a lot more to it in the price of insurance than just the claims. So,
And it's interesting that you mentioned it that way because you even mentioned capacity and so forth. I think what happens in our business, and correct me if I'm wrong, is that we get into this insurance speak where you're a business owner, you're in charge of a large organization, a large company, and you got your terminology, your vernacular. But I think when an insurance professional talks to someone about where the markets are going, they may put too much in there about, or it sounds too insurancy for someone. So with a CFO audience and a CEO audience, why don't you tell us a little bit about what this is doing with this market?
yeah, here's the best way I can explain kind of the totality of how the insurance domestic marketplace comes up with their pricing. It has certainly does, as I said earlier, have to do with claims. That's one component. The other part of it, which most people aren't aware of, insurance companies invest when they take in premiums. One of the things they're allowed to do with those premiums is they put them to the side and put them in what they call reserves to eventually pay claims with those premiums. The insurance carriers are not allowed to invest that, what they call the float, those premiums. They're not allowed to invest it in the stock market. But what they are allowed to do is they're able to buy bonds. So one of the things that you may or may not be familiar with is bond. I think everyone knows in business, interest rates have come down substantially. Well, one of the ways outside of underwriting profit that insurance companies make money, in fact, the largest way they make money outside of underwriting profit is yield on the bonds that they purchase. I can give you a good idea. It's probably been a little less than 2 years ago. The 10-year treasury, which again, if you're not even familiar with that, right? You loan the government money, you buy a bond for 10 years, you
Right.
get your interest rate, you get your interest paid every year for 10 years, and then at the end of the 10 years, you get your money back. Well, a little over just about 2 years ago, give or take, the 10-year treasury was paying close to 3%. Today, and I haven't looked today, but I think yesterday when I looked, it was 67 basis points. So if you think about that, same is true with corporate bonds that some of the insurance companies will purchase. They're basically their return on the float, those premiums that they're holding in reserve to pay claims, their investment income on that capital has come down so substantial that it's impacted their earnings. And so the only way to offset the lack in investment earnings is to charge additional premiums. And so, yes, claims are one component, but the yields on bonds are a substantial component to that. It's impacted the insurance companies in a major way. So that's one thing that is it's just not talked about very often. I think the typical insurance agent doesn't truly understand how yields work, how bonds work, and the impact on the insurance markets. So they'll generally tell their clients, it's just a claims issue or a capacity issue. Now, the capacity side, I didn't get into what that is. Carriers, when they compete against each other, insurance companies, there is a certain amount of capacity in the market. And what that means is all of the insurance companies that compete, they're willing to put up a certain amount, they're willing to take on a certain amount of risk. And so the amount of risk they're willing to take on is the capacity in the marketplace. If you're in a soft market where premiums are going down, there may be carriers that want to get more involved or less involved, and the same is true when premiums go up. Well, right now we're in a hard market. So premiums for most products in the insurance industry are going up. They're on the rise. So because of that, you have some carriers more aggressive and some that are less. But one of the reasons the market is so hard right now outside of claims and interest rates is there is a lot less capacity right now because there's a couple different marketplaces in insurance worldwide that really drive rates. Okay, you have the domestic marketplace where the U.S. is a big component. The other is a substantial component is London, right? So the Lloyd's of London and the London marketplace is a big part of writing large accounts all over the world. And then there's also a pretty big marketplace in Bermuda. So the last number of years, the non-domestic marketplace has gotten hit pretty substantially with some serious claims. Because of that, the capacity in those areas has shrunk. So they're competing less on domestic business in America. Therefore, the domestic carriers have got all of the risk they're willing to take unless people are willing to pay higher premiums. And so that's another factor that drives premium.
From an immediate perspective, we could just look at a microcosm of that. And in your state of Florida, where you've had so many different natural disasters with the hurricanes, and then when that happens, rates obviously go up. These insurance companies, they get hit with substantial claims, and then they're just like, they're not willing to take that risk. And then what happens is the pricing obviously goes super high, right? And it's very difficult to get the right type of coverages for an affordable price. That's the one thing. And then the other thing, I just talked to a friend of mine, and you know him very well, Kevin Dorse with Amwins.
I do.
And I do a lot of work with Kevin on the executive liability side, and we're looking at some D&O issues, and then we're also looking at some EPLI. And one of the things he's been concerned with is the response of how directors and officers have been working with COVID. And so he has told me that is having an effect on the executive liability market. So it can be, like you said, investment with regards to bonds. It could be the capacity issues, and that's going to be predicated, of course, on claims and also on the types of risks that are being present, like we have with COVID. So, and then you mentioned Lloyd's of London. What other factors are there that would have an impact on how the insurance business works and its ultimate effect on those rates?
Well, one, I will tell you, Brian, that has really creeped up in the last handful of years, that is a substantial issue, is social inflation. And the reality is what social inflation is a claim that might have gone to court, or there was a battle in court on a liability issue or something of that nature. A claim that may have settled for a few $1 million 4 or 5 years ago now is settling for multiples of that. We have seen much more litigation. We've seen more involvement from attorneys. And the social inflation number, I can tell you, is one of the things that has the insurance marketplace concerned. When you're looking at the average judgment and the increase year over year in that number, it's been substantial, and it's on a 5+ year trajectory that is substantially higher than it's been. And from everyone that I talk to, they don't see that changing. So that's another floor underneath rates that's going to keep rates, I believe, high for the time being until there's some sort of reform in litigation, some sort of tort reform.
Yeah,
I can tell you that's a major driver.
And we've talked about tort reform in this business ever since I entered it back in '91. I mean, it's always been something. There's been some movement on that. I never even thought about the social impact, though. I was really thinking more about some of the more technical things, but that makes a lot of sense. If your judgments are going to be that much out of whack, so to speak, and then once you have that precedent set, what are some of the types of losses or lines of coverage that you're seeing this have the most impact on?
Yeah, honestly, excess liability, or umbrellas as they're otherwise known at, because again, a claim that might have only hit the underlying GL policy that might have $1 million or a $2 million limit, mm-hmm. Those claims now that are larger are hitting the excess, the umbrella. Because of that, there is a very competitive, or a very hard market in the excess liability space, because in the past it was very rare when you would have claims that would hit the excess liability layer. That is, the increase in that area has been substantial. So that's certainly one. Auto is another one, Brian. Again, part of that is social inflation with people that have injuries and whatnot. Those claims are being driven up. But the other side of that is the technology in vehicles now is so much better than it used to be. A little $250, $500 fender bender 5 years ago is now $3,000 because of the sensors and the technology in those vehicles. So that alone is causing even minor claims to be a little larger. Coupled with the social inflation and the litigation is why you're seeing auto trend extremely high right now. I will tell you, I don't have up-to-date 2020 numbers, but in 2019, there were literally almost few, if any, carriers that actually made a profit in auto because of the situations that we're talking about. Because of that, carriers now, if they're willing to be competitive on your auto, and many times they're wanting to write the general liability or the workers' comp just to take on the risk of being on that auto. And again, and the umbrella, the excess liability above that auto is also extremely hard right now, because they're fearful of a bad accident turning into a big litigation issue that then hits that umbrella or excess liability. The other area that I would say that we're seeing increases in, certainly in real estate and property. At IOA, we do a lot of it, especially coastal real estate. Because of all the storms that you mentioned, that's a big driver in that area as well. And then on the real estate side, the liability on real estate policies has gone up substantially as well for similar social engineering claims of, violent shooting, some of the other things. Obviously now we're seeing an increase in some rioting and some of the unrest that we're seeing right now. That's going to further increase rates on the property side. So we're, the difficulty that we're in right now as a country is we're experiencing a hardening insurance market in an economy that's struggling to come out of a pandemic. So you've got businesses that probably aren't back to pre-COVID revenues yet, but yet they're buying insurance and those rates are going up when their revenues may be coming down. So it's certainly pretty difficult on business owners today, which is one of the reasons that we're trying to educate our partners on how to educate their clients, the things that we're talking about today. Because again, most agents will gloss over some of the details we're diving into and just say, well, it's capacity issues and there's been a lot of claims. But again, it's a lot more to it than that.
Well, you covered a lot of stuff today, and I'm really grateful for the time you took to go over some of these things with us, because I think many people just don't understand. And having someone in your seat that sees it from a much more holistic perspective than, let's say, an agent or a broker that may be, in one industry or one line of coverage, so to speak, or even just a few, from your perspective of seeing it, it certainly does lend, not only does it lend credibility to that, but it also helps people understand in a much, much better way. So thank you so much. I really appreciate you spending some time with me today.
My pleasure, Brian. It's great to see you.
Likewise. Thank you.
You got it.